We turn our attention on to insurance matters with a very familiar face on the channel to talk about something different. Wayne McCurrie, Head of Wealth Portfolio Management at Momentum. Wayne, so good to have you with us today.
Yeah.
Long-term insurance. Maybe
Yes.
let's get into the definition there of...
Long-term insurance encompasses lots of things. Now, first of all, there's no pure long-term insurance company left in the country. All insurers now is long-term, short-term, risk, car insurance, house insurance. They've diversified into every aspect. But if we're just talking long-term insurance, there's essentially two things that a long-term insurer does. It underwrites risk, i.e. the risk of you dying or the risk of you becoming incapacitated or unable to work, and then pays you out either a lump sum or an annuity amount if it's a disease. Second thing they do is they provide long-term savings. Most of it is what's called discretionary, i.e. retirement savings, but there's also a lot of non-discretionary savings as well that's in the mix. But pure long-term insurance is what happens if I die and how do I plan or save for my retirement.
Quite a lot of avenues that you've mentioned there, Wayne, but many people might wonder about the importance thereof. Some might say, well, I'll die anyway, depending on who my riches are left for.
What about your children and your dependents and stuff like that?
Precisely.
Look, my personal opinion is that you're stupid not to have life insurance cover because you might die before you expected to die. So we all expected to die at, I don't know, 75, 78 or 80.
I wouldn't mind. That's a good age for me.
But, you know, that's one of the sad things is you don't know when you're going to die.
True.
So you can't plan properly for it. So you take out life insurance that in case you die and you've still got dependents, they will be adequately looked after. I mean, quite frankly, if your dependents are independent and they're on their own feet and you've got no debts, you don't have to have life insurance because you know when you pay out, you can't pay out to yourself. But in the interim, until that happens, you have to have life insurance. And in the bigger scheme of things, when you consider what life insurance pays out if you die before you're supposed to die, it's actually quite cheap.
Having said that, though, would it be ever a potential option to cancel your life insurance or long-term insurance?
Why not? If you got no dependents, you got no debts, you're solvent, you haven't got a liability in your estate, why pay a premium when the money just goes to your estate when you die? So if you have obligations where if you die before you expected to die, there are people who will suffer because of your death, then you have to have life insurance.
Wayne, I'd also like us to touch on some of the other areas that you mentioned where you need to cover your risk. Disability cover, there's even retrenchment cover. Yes. So a lot more creative products on board
It's insurance. Now. Do you drive a car without insuring your car?
No.
You're incredibly silly if you do. Exactly the same with your life. You might be in an accident tomorrow or get a disease and you can't work anymore, but you're going to live another 30, 40, 50 years. You've got to be covered for that as well. So that's all risk. That's risk underwriting, which was the traditional business of life insurers. That's how they started, underwriting risk.
But if we look at the normal terms and conditions, because I take it that's where consumers often get caught off guard here, reading the fine print and understanding the product that you invested in.
You must understand if you're taking, let's just say, when a life insurer writes a policy for you, they say, my age, I'm 55, I'll probably live on the actuarial tables till I'm 80. So I'll take out a policy until I'm 80. But remember, the life insurer incurs all the expenses virtually the day you sign the contract. They've got to pay commissions out, although commissions are spread nowadays, but they've got to incur all the new business expenses. So what happens is the life insurer, for argument's sake, pays out 10,000 rands worth of costs and then earns 50 rand or 80 rand a month for the next 20 years from your policy, and they pay that money back. So in the first 5 years or the first 8 years or however long, if you surrender your policy, the life insurers have got costs that aren't recouped yet. So they will take, that's a penalty or a surrender penalty. I mean, but the bottom line is, unless you really have to, don't surrender a compulsory product, a risk product, before expiry, because you're not going to get value out of it.
On the business case of this, though, going forward, it's interesting you've mentioned the landscape has changed. Now that people are living longer, is it still a viable option for investors?
Well, look, as long as the actuarial tables that you calculate life dependency on are kept up to date, then the longer duration, then you will adjust your premiums accordingly. But let's not talk from the life insurer side. If you talk about the consumer, you know, you're going to live, you don't know how long. So when you retire, you'll buy an annuity from a life company. And the annuity says, you give me 200,000 rand, whatever the number is, and I'll pay you 2,000 Rand a month until the day you die. So if you live till 90, you're still going to get your money.
Is that guaranteed, or isn't it last until the funds actually depleted?
No, it's guaranteed, because the life company's got a big book. So let's just say they've got every 55-year-old in the country is expected to die at 80. Some will die at 70, some will die at 90. So on average, they will all die at 80. So the life insurer underwrites the average. So the nice thing about that is, it doesn't matter how long you live, you are going to get this amount every single month on a retirement annuity.
Is this where the right direction maybe that consumers should be taking versus what we see with some provident funds where people get a lump sum?
You must never cash in the lump sum. Look, there are certain tax rules when you retire. You're allowed to take out 1/3 in cash, but the 2/3 you've got to buy an annuity. It's law. So you can't actually squander the money. But of course, if you leave before your retirement age, what used to happen is that people took that money and spent it. So you find lots of people resigned because they had debt issues. They didn't resign because they wanted to leave the company. They left to get the pension. Now there's been dramatic change in the laws around that. It's very, very difficult to do nowadays. First of all, you've got to pay back all the tax, because remember, retirement annuity is tax deductible and your pension fund contributions are tax deductible. So you've got this big upfront tax thing. If you put it into another pension fund, you don't pay that tax. But there's a whole lot of other laws that have come out to stop people doing this. Because what happens is you change jobs 2 or 3 times, you get to retirement age, you haven't got a pension. You haven't got enough money to retire on. Then you go live with your children.
Preserve, preserve.
Very much
That's
so,
clearly the message here. But are we finding that there is a link between the mindset of consumers? I take it differs from the various LSM
Look,
groups.
surprisingly enough, most people who have formal jobs in South Africa are actually quite well looked after retirement-wise, simply because the government never provided adequate. So in fact, we're one of the most provided group, as long as you've got a job. In other words, if you're in formal employment, you're actually quite well provided, because you have to join a pension fund, you have to contribute to a pension fund. So it's actually quite well looked after. But of course, there are exceptions to it. And I suppose when you retire, you must be very careful that you'll have enough money when you retire. And the only way to truly sort that out is start early and don't touch it. Just leave it. It's amazing how things compound over the years.
The eighth wonder of the world.
As long as you leave it alone and don't fiddle. You'll probably leave it alone, diversify your portfolio, don't, the commonly known things, don't put all your eggs in one basket, invest in a broad spectrum of investments. You leave it long enough, you'll probably be okay.
Leave it long enough. Start early and don't touch it.
Start early, don't touch it. No.
Sound words of advice. Wayne, always a pleasure speaking to you, even though it was a different avenue today, but always good learning from you. That was Wayne McCurrie, Head of Wealth Portfolio Management at Momentum Wealth.